And here we are at the top of the hour. Good morning. Welcome to today's Strategic Farming Let's Talk Crops program. We're happy you have joined us for today's session on farm finance, news from grain markets, FINBIN and USDA data, and the Farm Bill. These sessions are brought to you by University of Minnesota Extension and generous support from the Minnesota Soybean Research and Promotion Council, as well as the Minnesota Corn Research and Promotion Council. I'm Matt Farr, University of Minnesota Extension educator based in Mankato, and I work with the Crops Extension team. We welcome to today's Strategic Farming Nathan Hulinsky. Nathan is with the University of Minnesota Extension educator in agricultural business management. He is based out of the Brainerd Regional Extension office. And Dr. Frayne Olson. He is a crops economist and marketing specialist with North Dakota State University Extension. Frayne is also the director of the Quentin Burdick Center for Cooperatives and a professor in the Department of Agribusiness and Applied Economics at NDSU. Gentlemen, welcome to you both. We are glad to hear from you today. So with that, I will turn it over to our first speaker for today, Nathan Hulinsky.
All right, well, thank you, Matthew. All right, hello, everyone. I am Nathan Hulinsky with the University of Minnesota Extension, and I got about 20 minutes to talk about some crops updates that we're seeing in Minnesota. So we'll get started. I do first off want to highlight that the University of Minnesota Extension website does have a lot of this information that I'll be going through today. So just to find helpful rental rate information, crop budgets, and farm bill information, our University of Minnesota Extension website does have a lot of this stuff highlighted and readily accessible for everybody. So first off, I'm going to start sharing some USDA crop numbers. So these are for 2025 Minnesota crops, just highlighting how it looked like the last couple of years. All of this data came from the USDA crop production report that came out last week. So getting started, I want to highlight our top crops that we do grow in Minnesota. So you can see I have 23, 2024, and 2025 data on the screen here, and we can see the acres planted, yield per acre, and total production. So I want to highlight in 2025, Minnesota grew 8.9 million acres of corn. And we did have a record-breaking yield, first time ever in Minnesota, where our average yield was over 200 bushels per acre. The USDA said that we had 201 bushels per acre on average. So pretty impressive yields for crop year 2025. I do want to highlight my farthest right column, that number 4. Minnesota is the number 4 state in terms of acres of production of corn. So I believe Iowa, Illinois, Nebraska are ahead of us, but Minnesota is the fourth largest planted acres of corn. I'll highlight briefly soybeans. We had a little over 7 million acres planted of soybeans the last 3 years. Our yields, we can see, are hovering between 45 and 52, 53 bushels per acre. We are the number 3 state in terms of planted acres of soybeans. So again, we are very heavy agriculture state, right? We are number 3, number 4 in corn and soybeans. I also want to highlight our next most grown crop is actually hay. So this is all USDA data. And in 2025 in Minnesota, we had 1.28 million acres of harvested hay. This is both grass and premium alfalfa all combined. But yeah, a lot of hay in the state. Number 10 in terms of acres of hay production. And then spring wheat. Spring wheat, we are the number 3 state for spring wheat production. So just kind of want to highlight some of this stuff. I do want to highlight some of the other crops that we grow in Minnesota. Clearly, corn and soybeans are number 1 and number 2, followed by spring wheat and hay there. But sugar beets. Minnesota is the number 1 state in terms of planted acres of sugar beets, and it's not really a close margin. North Dakota is second, and we grow about twice as many acres of sugar beets as North Dakota. Second one, dry beans. I just want to highlight this. I think this probably isn't as commonly thought of a Minnesota crop, but our dry beans. We are the number 2 producer of dry beans in the country. We have about 295 1,000 acres of dry beans, so considerably less than corn and soybeans that are 7 and 8 million acres. But our largest acres here of sugar beets, black beans. So about 35% of all the acres planted in Minnesota are black beans. We're the #2 state producer of black beans after Michigan. And then both the dark and the light red kidney beans, Minnesota is the #1 producer of those. And then pinto and navy beans, we grow, from 16 to 9% of our planted acres go to those crops. And we're still a top 3 producer of navy and pinto beans. And then our next most produced crop here, and this is all based on planted acres, is oats. I just read this morning that the University of Minnesota has a new variety of oats that came out. Minnesota Amber just came out here, and we are the #1 state for planted acres of oats. So we do grow a lot of oats in this area, still about 245,000 bushels, so not a huge crop. Again, compared to everything to corn and soybeans, these crops are minor, but we still are, it's a major crop that we have. I want to highlight canola. We're a #4 producer state for canola, about 115,000 acres. And then just the other final crops that we do plant here are sunflowers, a #3 state on sunflowers, a #5 producing state for rye, #8 in barley, #9 in potatoes at 40,000 bushels. And I do have to highlight maple syrup. Maple syrup was in the USDA handout here. We have 3,200 acres of harvested maple syrup, which equates to about 77,000 taps that Minnesota has here in 2025. And we grow or we harvest about 24,000 gallons of maple syrup. So fun facts for everybody this morning after we finished eating our pancakes. So I want to highlight some FINBIN data next, and just talking about some cost of production. So cost of production is very important for farmers to know. Frayne Olson is going to speak in about 20 minutes, and I think he's going to talk a lot about crop pricing, crop updates. So knowing your cost of production is important. This is University of Minnesota FINBIN data, the state of Minnesota as a whole, and we can see our corn cost of production on the top there between $4.83 in 22, jumped 10 cents into 23, dropped 20 cents there into 2024 at $4.71. I think if we go to look at our current cash prices, we're below $4.71 for most of the Midwest. So hopefully Frayne will tell everybody how to sell corn at a profitable level. Soybeans, our cost of production, this is the state of Minnesota as a whole, is around $11. And if we go back, our cost of production for the average bushel of these crops just 2, 3, 4 years ago, it's going to be significantly lower. I think in 2020, our cost of production on soybeans was around $8. So we've jumped about $3 here just as the price of inputs have increased. Everything from fertilizer, chemicals, machinery, fuel, all these different expenses add up. And you can see the spring wheat cost of production on the screen there as well. Actually, it's dropped a little bit, close to $8 in 2022. Dropped, about $1.50 there into 2024, about 6.25. But with that, I have this breakdown. This is a benchmark report from FINBIN that breaks down these 10% buckets. And the 10% are based on farmers' total cost. So like we just have on the 10% for corn at the top, that's the highest cost of production 10% of farmers in the data set. And this FINBIN data set encapsulates about 10% of Minnesota corn and soybean farmers. So it's a fairly robust data set that we have access to. And we can see the bottom 10% of corn growers in Minnesota had almost a $7 cost of production. So that's pretty alarming. That's a full $2 over the average. So clearly we're not making money at $6.92 cost of production. The next 10% drops a full dollar. And if we go all the way to the far side of the screen, the best 10%, that 100% bracket, they're producing corn at $3.19, right? So that's a profitable level. So I just want to highlight knowing where your cost of production is very important, right? We have this wide range from 319 all the way to 692 in 1 year in one state. Very similar scenario here on soybeans. The bottom 10% of cost of production here is over 16 and a half. Again, that's not a profitable level, right? Where we go all the way to the far side of the screen, we have $7 soybeans, right? So again, this humongous variation, high to low, of almost $10 just to grow 1 bushel of soybeans. So again, knowing where your own cost of production is very important to highlight at what point can we sell these soybeans at a profitable level. Similar story on on spring wheat there on the bottom. The bottom 10%, 11 and a half. The top 10%, just over $4. So this humongous range high to low. And that's why I just want everyone on this call to understand using the FINBIN average cost of production maybe isn't the best fit for you. Maybe you really do need to track your own cost of production. What are you spending on seed cost per acre, land rent, or fertilizer expenses? What's your machinery cost per acre? To understand what your actual cost of production is on the farm to sell at a profitable level. Some more FINBIN data here. This is going back 20 years. Unfortunately, the 2025 data is not released yet. It will be released probably in about 2 months. It's usually kind of the middle of March, 1st of April-ish time frame that these most recent year's data is published. So this is median net farm income for the state of Minnesota, specifically to crop farms. Okay, and we're all familiar with, we go back, right? We had the ethanol boom, kind of started in 2007, 2008 were pretty good. We had a dip in 09, and then we all remember that 2010, 2011, 2012, where we had the red line is inflation adjusted dollars. In 2012, we had $350,000 of median net farm income in Minnesota. So very strong farm incomes. Unfortunately, from 2013 all the way through 2019, we were hovering around that $50,000 of income, which is just not strong income, right? We had some financial struggles through that period. And then kind of during post-COVID there, 2020, 21 into 2022, really high income, right? 2022 was really, really strong income, especially nationwide on the farm, where we had, again, over $200,000 of income, both in 2021 and 2022. Significant decrease, right? This heavily follows crop, corn, and soybean prices. 2023, we had a significant drop around $50,000. And unfortunately, in 2024, the median net farm income was about $2,400. So clearly over the last 20 years, that's the lowest number on record. So unfortunately, last year was not great. I'm very curious to see what 2025 data looks like. Price of commodities hasn't been fantastic, but we just showed on my previous graphs that our yield of corn and soybeans were above average overall in the state of Minnesota, which typically leads to slightly higher incomes, but it just depends on where prices for both inputs and commodity prices end up. I do also want to highlight here, income varies across the state. Part of this is the crop rotation. Part of this is just weather patterns that we have. Certain areas get drown out spots. Certain parts of the state have, yield issues for whatever reason. And again, this is 2023 compared to 2024. The 2025 data will come out in about 2 months. But we can see, I'll pick on Northwest Minnesota. In 24, they had $54,000 of income on the median for that part of the state. You can see the highlighted counties, which was about a 45% decrease from 2023. We can see in the northeast part of the state, they actually had an increase of their farm incomes. And then we look at West Central Minnesota. They had a pretty strong decrease from 23 into 2024. And similar with the whole southern tier, uh, most of them saw a decrease. Southeast Minnesota, a slight increase there, but that's just kind of regionally how they break down as we move across the state. Next, I want to switch gears and talk about some of the Farm Bill and other USDA updates. I do want to highlight the Farmer Bridge Assistant payments. This was released kind of early, or this was publicized early December. These payments should hit farmers' bank accounts the end of February. So these are a per acre payment based on 2025 planted acres, and we can highlight corn, a $44.36 per acre payment, again, based on 25 planted acres. This is a total of $11 billion nationwide. We can pick on soybeans on here as well, right around a $30 per acre payment. So there's always talk in DC of additional payments. They were potentially saying there was going to be, we don't know, we can't speculate on what's going to happen. These are approved, and again, these will hit farmers' bank accounts in about a month. And we can't highlight oats, for whatever reason, is a fairly strong payment. Minnesota, again, the #1 planted acre state for oats, and that's an $81 payment. So it's not nothing. I just want to highlight this for everybody that's on the call here. And I'll spend my next 5 minutes discussing Farm Bill and Farm Bill updates. We can see these are actual payments that were based on the 2024 crop year. These payments hit farmers' bank accounts about a month ago for the most part. With the government shutdown in kind of October and early November, things got quite a bit delayed, but these payments should be in farmers' bank accounts already. And we can see there were some canola payments, a few oats payments, a handful of decent sunflower payments, quite a few wheat payments. I can share these with everybody if they want to see these. I'm going to go through them kind of quickly. There are some strong corn payments. Roughly 30% of all Ark County corn payments nationwide went to the state of Minnesota. So we did have some really strong payments here in Minnesota. You can look at kind of south central Minnesota. A few counties were over $100 per acre on these Farm Bill payments. This is for Ark County. I do want to highlight these payments are paid out on base acres, not planted acres. So there is a difference there. But again, strong payments here on corn. Strong payments here on soybeans as well. Not as large as the corn payments, but there are a handful of counties, $50, $60, $70 per acre here, which is, again, a strong number. These Ark County payments do not pay out every year. It's a predetermined formula, and they just don't pay out every year. But 2024 crop year was a pretty strong year for payments in the state of Minnesota. So moving forward, what's the Farm Bill going to look like? So I just want to highlight to everybody, there's 12 titles, 12 sections of the Farm Bill, and this is a rough breakdown of what the payments all go to. And I think it's no surprise to most of the people on the call today, the vast majority of the totals Farm Bill's outlays, like budgetary number of dollars that are being spent, go towards nutrition. Right, that's going to be some of the food stamps, some of the WIC programs, the Women's, Infants, Children, the SNAP, which is the Supplemental Nutrition Program, Assistance Program. So the vast majority, right, over 3/4 of the entire Farm Bill's expenditures go to nutrition, right? That's over the course of decades. That's kind of how the Farm Bill has been morphed into. I'm going to talk specifically Title I details today, and I got a few minutes here. So this is base acres. Those are the base acres that Minnesota has. You can see the big ones, again, corn, soybeans, wheat, few, barley, oats. As they get smaller, sunflower, canola, dry peas, and grain sorghum are also on there. Nationwide, there's about 240 million base acres in the state of Minnesota. or excuse me, in the entire nation. So through the one big beautiful bill that was passed July of 2025, there were some pretty significant changes to Title I Farm Bill programs that farmers have. One of the big ones is it raised the payment limitation that farmers have from $125,000 to $155,000. So before, you were maxed out once you hit $125,000 of governmental farm payments. They increased that $30,000 to $155,000. And another big change prior to this most recent legislation, all persons in like one entity. So if you had a farming LLC, that LLC was limited to one payment of $125,000. Now, if you have two brothers farming together, each brother gets the $155,000 limit. So that's a significant increase in potential payment maximums to farms across the country. So again, it's not unusual for farms to be set up in a different form of a partnership, an LLC, an S corporation, C corporation. Prior to, all those were limited to one payment. Now it's however many of the majority owners who are actively involved in the farming business. Other big changes, reference prices have changed significantly. I have another slide on that just in a second here, but starting in 2031, they are mandated to increase at 0.5% annually. And specifically for 2025, farmers will get the higher of either ARC or PLC. So farmers back in the spring last year chose either ARC or PLC for their base acres. You can change it between corn, soybeans, oats, spring wheat, but each crop had one choice. For 2025, through this legislation, farmers will get either the higher of ARC County for their county or their PLC payment for their farm. So that is expected to be nationwide a fairly large increase in additional payments that farmers got the maximum. Because looking forward into 2025, or the payments for 2025, which will be issued in October of 2026, we have a few months before they're finalized. Both ARC and PLC are expected to have payments. Farmers will get the higher of the two. And for the 2026 Farm Bill decision, the date to sign up has not been released. Typically, it opens about now and closes on March 15th. The USDA said this is not going to be open for a while. The one report from the USDA said, or the one legislature in DC stated that farmers will probably know their yields of 2026 before sign-up opens. So sign-up might not open till the fall. So I will keep everybody in the loop on that, but don't worry about signing up in the super near future. Up to 30 million new base acres will be added. So that will be prorated if every farmer known to man wants to add as many acres. That's a nationwide thing. ARC now has a revenue guarantee at 90%. It was 86%. Max payments per county are 12% of average revenue. It was 10%. So both of those changes, it results in about an 8% increase higher maximum payments for ARC County. For those corn payments in Minnesota I highlighted, most of those were the maximum payment per county. So those are significant changes. Also, you can use supplemental coverage option with crop insurance on ARC acres. You could not do that before. I am told that may be a short-lived change. So if you want to do it, think fast on it. That might not be around moving forward much. Final slide here, reference prices have increased. We can see wheat. In 2018 Farm Bill, it was $5.50, and now the reference price with that One Big Beautiful Bill Act, $6.35, right? So we jumped 85 cents. Barley, similar increase. Everything had a double-digit percentage increase. Corn from $3.70 to $4.10, so a 40-cent increase on the reference price. And soybeans is the big one here. It was $8.40. Now it is $10. So that's a fairly strong increase in reference price here, which this is what, like with that OBB column, that is when PLC will come in. It'll pay the difference between that number and what that market in year average is. So at $10 on soybeans, that's a very strong reference price. So bunch of changes here on the Farm Bill moving forward. Farmers cannot sign up just yet, so hold your horses. I do want to one more comment. DMC, the Dairy Margin Coverage Farm Bill program, sign up did start. And farmers who enroll into the 6-year coverage option, Minnesota legislatures will kick in and pay part of your bill after the fact. So just keep that in mind. And with that, that's all I got, Matt.
Thanks, Nathan.
I will stop sharing my screen so Frank can get going.
Absolutely. Well, it was a pleasure to have your take there on the Farm Bill and the local economy. And I know Frayne's going to blow that out to a wider perspective. For those that didn't catch my introduction this morning, that was Nathan Hulinsky. He's a University of Minnesota Extension educator in ag business management based out of the Brainerd Regional Extension Office. He's going to stick on till the end, right, Nathan? For any questions directed to you. Okay, now we're going to turn things over to Dr. Frayne Olson. Again, he's the crops economist and marketing specialist with North Dakota State University Extension and a professor of agribusiness and applied economics there at NDSU. Frayne, welcome.
All right. Thank you, Matt. Can you hear me and see everything okay?
Everything's great. Thanks.
All right. Fantastic. So let's dive right in. Thank you for joining us this morning. Hopefully everybody's staying warm. I'm going to talk a little bit about the crop market outlook. Also talk a little bit about some of the trade things going on. I'm going to focus most of my comments today on corn and soybeans. If you do have some questions about wheat or some of the other crops that Nathan was just talking about, I can certainly try and cover those as well. So all of my topics, or all the time that I do this, I try and really provide some historical context. To help you understand, are these numbers that we're floating around, you probably hear it on the radio, you read it in the paper, are these big numbers, little numbers, what is our reference point? So I just want to go back kind of historically right now and look over about the last 25 years on the planted area of crops. And again, similar to what Nathan is, I'm trying to set this up for where are we today in the markets and what does this mean as we move into 2026? So the gold line on top is corn planted area for the entire U.S., not just Minnesota, but the entire U.S. The green is soybeans. The brown is all wheat. So that's all spring wheat, winter wheat, soft wheat, white wheat, durum, all blended together. And we have some of the other crops towards the bottom. And notice also alfalfa hay nationally is also one of the major crops that we grow in the U.S. So as you can probably see, focusing on corn and soybeans, we tend to see this flip-flop or inverse relationship between planted area for corn and beans. It's not always a one-to-one. You get into North Dakota, South Dakota, parts of northwest Minnesota, we've got different crops that we can grow. But you look at the heart of the corn belt, those are the two big crops. Notice, please, that we saw a huge increase in planted area for corn, pretty significant decrease in planted area for soybeans. And I'm going to show the specific numbers in a little bit, but right now the market analysts and traders, kind of those people that are doing the forecasting, are looking at a reversal, or more of a reduction in corn acres and an increase in soybean acres moving into 2026. Okay, we'll wait to see what happens with that, but that's the current thought process when we think about what prices are doing and kind of what the market attitude is right now. So as a marketing guy, I usually look at these numbers. This is the production. So how many bushels did we produce? Again, the gold line on top is corn. The green line is soybeans. The brown line is wheat. Just for perspective, so in the United States, when we say wheat is king, this is really what we're talking about, just the sheer volume of corn that's produced. Also notice on the right-hand side, 2025 was a record production. I mean, by far, we blew the top off the previous record for corn bushels produced. The previous record, if you can see my arrow, the previous record here was in 2023 versus the new record now in 2025. If you look at that differential, we took the previous record, we look at the increase to the new record, that was about 1.68 billion bushels. So let's just round up to 1.7 billion bushels. Simple math. Well, that increase from our previous record is almost the size of our entire U.S. wheat crop. So in the United States, we produce about 2 billion bushels of wheat, not quite. and our increase in corn was 1.7. So just for perspective, I mean, this was a massive year. A lot of that, the majority of that, I'm going to argue was because of the increase in planted area. Yields helped. We had some very, very good yield reports, but really this is an increase in planted area. So let's look at some of the details. And again, I'm not going to go through all of this information. I just want to give some historical reference and some perspective. So this is a table of the supply-demand table. This is out of the WASDE, the World Agricultural Supply and Demand Estimates. USDA updates these numbers every month. So the column on the far right-hand side is the current crop year, or the current marketing year. So this is the crop we harvested in 2025. We're selling now in calendar year 25 and 26. The column in the blue in the middle is last year's numbers. The column in the green on the far left-hand side is from 2 years ago. We're just going to use those as references. Okay, so as a marketing guy, again, I tend to look at the production numbers. So when we look at bushels produced this year versus previous years, you can see, again, 2023 being our previous record, this was a massive crop. The challenge we have right now is how quickly can we use up those bushels? Okay. When we look at total consumption, again, the production numbers, let me go back. The production numbers, those are pretty much locked in right now. So based on USDA's estimates, and it's not only farmer survey data, they're cross-checking this data with RMA, which is crop insurance information. They're cross-checking it with FSA data, which is for farm program analysis. We're not going to see any changes in the planted area, harvested area, or yields going forward. So our total production number, that's not going to change. However, when we look at total consumption, the usage numbers, some of this is also forecasted. So we've got some real information, some actual history. We know how much we're starting to use, in particular for ethanol as well as for exports. But we also have a lot of projected numbers. So moving forward, these numbers can change and shift a little bit. Our consumption is also expected to go up. Given the big production, lower prices, we are expected to have increased consumption numbers. The real question is, how much inventory are we going to have left? So as we get into the harvest of 2026, are the bins going to be full or are the bins going to be empty? That's one of the core questions, and psychologically in the marketplace, that makes a huge difference. So I'm going to spend a little bit of time talking about this carryover stocks, or what does our inventory look like? I'm going to use a percentage, not an absolute bushel count, but a percentage. So we're going to take this ending stocks number in bushels divided by total use in bushels. So we're looking at a percentage. This chart here, the columns, the blue columns towards the bottom are that percentage number. So what percent of inventory we have relative to our consumption? So just for reference, the green line on top is total bushels produced. The red line on top is total consumption. And we have this ending stocks as a percentage. So it's the stocks to use ratio. Now, typically what happens if our ending stocks are really small, for those blue bars are small, we tend to have high prices and we tend to have a lot of price volatility. We get a lot of bouncing around in prices because we're coming into harvest and the bins are almost empty. And 2012 is an example of that. 2020 as well as 2022 are examples of where we had really tight inventories, we had very high prices, a lot of price volatility. On the flip side, if the bins are full coming into harvest, we tend to have lower prices and a lot more price stability. It takes a lot more shocks to the system, big news, to get the markets to move. If you look at the column on the far right-hand side, the red bar, that's where the current USDA forecast is at. So what I want you to look at is how are we sitting today? The current forecast, this can change, but the current forecast compared to history. And if you kind of eyeball that, most people say, well, we're average to maybe slightly above average for carryover stocks. So if we're looking at average inventories, average carryover, what that suggests is we should have kind of average prices. And I'll show you some charts in a few minutes to test this. So my point is, we're not short of corn in the United States. Globally, our inventories of corn are still very adequate. Brazil is starting to harvest their corn right now, just barely starting. They've already started harvesting their soybeans. So globally as well as domestically, Corn supplies are very, very adequate, very comfortable. If you're a buyer of corn right now, you're pretty much in the driver's seat. Let's shift to soybeans very quickly. Again, when we look at planted area, when we look at yields, when we look at total production, even though our planted area dropped, our yields increased this year. We had a pretty good soybean crop nationally. And you look at total bushels produced, we're pretty much right in the middle of where we have been the last couple of years. When we look at consumption, total bushels consumed, now again, a lot of this is forecasting, and we do have some real information when it comes to crush and crush capacity, as well as how quickly we're using up the soybeans. We have some pretty accurate data on exports. So some of this is real numbers, some of it's forecasted to the end of the year. If you look at our total consumption, again, pretty much right in the middle of what we saw in 2023 and 2024. How about our ending stocks? Ending stocks are going up a little bit. So we produced more, prices are dropping, we are consuming more, but the real question, at least from the soybean standpoint, is what's happening for exports. So what about ending stocks? How are we sitting for ending stocks, the forecasted ending stocks this year versus history? And one of the things we have to do now is we've got to really kind of eliminate this 2018 and 2019. 2018 and 19, that was our trade war number one with China. Okay, and so if we take those out, because those were really kind of odd years, and we look at how are we sitting the inventory levels today versus history, it's like, well, we're pretty comfortable. It's not excessive. They're not like we saw back in the early 2000s, but it's certainly not short like we saw in 2012 and 2013. Okay, so how do we get rid of all this corn? When we think about USDA and their forecast for total consumption, let's look at what they're forecasting today relative to history. Okay, so the dotted lines on the far right-hand side are their current USDA forecast. Let's compare those forecasts to history going backwards. Now, the blue line on top is feed. Technically, it's feed and residual, but let's just talk about the feed pile right now. So this is whole corn that's been run through a combine and is either being used or consumed, okay? It does not include DDGs. It does not include corn silage. And if we look at what USDA is forecasting for total corn consumption, we're at very, very high levels considering where we are historically. In fact, these numbers right here are slightly above what we saw in the early 2000s. Okay, so that's a pretty aggressive forecast for total corn consumption. Again, feed and residual. How about for ethanol? Well, ethanol production has been pretty stable. It's looking like we have a slight increase. USDA is saying given the lower lower corn prices, we'll likely process a little bit more. But again, gas prices are down as well. So when you think about the margins, the profitability in the ethanol industry, it's okay right now, but not necessarily really aggressive. There's no real incentive to try and kick the ethanol plants into high gear. When we look at exports, the black line, again, an increase. Now, that's a pretty aggressive increase in exports. The black line from last year, last year's number is a record. That was record corn exports. USDA is forecasting an increase this year. And then we have kind of all other uses, which is the green line. Okay, so when I looked at that red bar that we just talked about, this includes the assumptions we're looking at right now. So in order to bring that red bar tighter, in order to get tighter supplies, we have to increase the consumption more than these numbers. And in my opinion, that's going to be kind of a challenge. So let's look now at soybeans. Two big uses for soybeans. Number one is for crush, which is the blue line. And we have had an expansion in the crush industry over the last 10, almost 15 years. It's been a slow increase over time. There are some new plants that have come online, particularly here in North Dakota and some in South Dakota. There's some existing plants that have been expanding. So that's a positive. Unfortunately, I think as everybody realizes, the red line, which is our exports, have been pretty soft, and primarily because of China. We'll show you some numbers in just a moment. Again, for reference points, this 2018-19 time period back here, that was trade war number one with China. And if you look at the numbers, technically, the current USDA forecast is below the level of exports we saw in 2018 and 19. So we really have to go back to the early 2010s to see this low level of export pace. Okay, so let's talk about not only how much are we selling, but who's buying. I want to explain this table really quickly, kind of give you some reference for historical exports by country. So the columns on the far left-hand side, these 4 columns, are 12-month totals. So that's for the full marketing year. Again, as reference. What I want you to focus on is the column on the far right-hand side. So these are export sales that are year to date. So how much of the 2025 corn harvest have we actually sold into the international market? Okay, now again, I did kind of a bait and switch on you here. This is in 1,000 metric ton. So we switched from bushels to metric ton because all of the international trade stuff is measured in metric tons. Okay, now this is how much we sold so far this year. It's not been delivered. Some of that's been delivered. Some of it has to be delivered in the future. But how much have we sold under contract? The column right next to it, to the left, is the same time period last year. So how are we doing this year relative to the same time period last year? And then the column to the left of that is last year's total. Okay, so let's just see, how are we doing so far this year? Well, Mexico is our #1 customer for corn, and they have increased their purchases significantly. And part of that is because of the New World screwworm and the fact that some of the calves in Mexico have not entered into the U.S. to be fed because there's a blockade of cattle crossing the border. Okay, so which means some of those calves have to be fed in Mexico. Their purchases of corn have increased. Japan is well ahead of pace. Colombia is about the same level. South Korea is well ahead of last year's pace. So if we look at the total, and just as a sidebar, ROW refers to rest of world. So that's all of the countries that I didn't have room for on my table here. If we look at total exports, we're about 30% above last year's pace, and last year was a record. Now, you'll probably also notice that China's well behind last year's pace, and last year's pace was pretty horrible. So in the corn market, historically, China has been buying more, but they have 2 things. They've increased their production domestically, they've been buying more corn from South America, and they're not buying corn from the United States. But when we look at total exports, other countries that we sell to have made up that difference. Let's look at soybeans. Soybeans, completely different story, right? China is our #1 customer. Mexico is our #2 customer. I just want to point that out. So if we look at other countries, Mexico down a little bit, Egypt is up, Indonesia is up, Japan is about the same, Spain is down a little bit, Germany is down a little bit. When we look at ROW, rest of the world, all of the other countries, they're up a little bit. We're down pretty significantly from last year's pace, and last year wasn't really a super export year. It wasn't bad, but it wasn't a super year. You can see that really the reason we're having such a slow pace is because of China. One quick comment, for decimal places. So if you instead of the comma, you put a period, a dot. So this would be 9.4 million metric ton, 9.4 million metric ton versus 20 million metric ton last year. So let me make a real quick comment about Chinese purchases. This shows information tomorrow. We'll get an update on these numbers. You probably heard in the news that private traders are saying that China has met their 12 million metric ton target based on the framework agreement that President Trump and President Xi had laid out earlier, several months ago. Now, the reason that these numbers don't show this is official sales to China. Now, some of those sales are kind of captured in this ROW. So in some cases, a U.S. company will sell to an international broker, and then the broker is working on behalf of a Chinese company. And so because we don't know exactly where that broker is going to resell those beans, some of them will likely be into China, we can't officially record those. So it's classified as unknown. So this unknown category, we know some of those sales were into China. And what's happened in the press, in the news, is they've surveyed these brokers and said, well, how much, based on your math, how much has China purchased? And that they're saying, yeah, some of these unknown sales are going to China. And when we add all of that up, it does come up to 12 million metric tons. They've met the target. Now, official numbers, again, from USDA do not record that because that's not being scored until the vessels are loaded. One more thing, I just want to be careful of my time here on seasonality. The seasonality of our soybean sales are very cyclical, right? Okay, so when do we sell soybeans? And this is important. So if you look at this, this shows a graph of how much soybeans do we sell every week. Okay, now it can be delivered later on, but how much do we sell each week? And if you notice, we get into October, November, December, our soybean sales for delivery in the future really spike. So during our harvest season, our export sales pick up. A lot of people come to the United States during harvest to try and buy and procure soybeans. By the time we get into January and February, those start to drop off because in January and February, the Brazilian crop Brazil starts harvesting their soybeans, and they're about 5 to 6% harvested right now. By the time we get into mid-February and March, our new export sales are starting to drop pretty dramatically. The red line is where we are this year, and so part of our problem is we've kind of missed this peak export season. Now, will we sell more soybeans going forward? Yes, we will. Are they going to be enough to move the needle? We don't know. One of the reasons we're seeing now some improvement today, I'll show you the charts in just a moment, we're seeing an up day in soybeans and an up day in corn. Part of that is because of an announcement or some additional weather information. We're starting to see some really dry conditions, some crop stress showing up in Argentina, not in Brazil, but in Argentina. And that's starting to put a little bit of lift into the marketplace. Now, Argentina doesn't sell a lot of whole soybeans. Most of their soybeans are crushed and they export the soybean oil and the soybean meal. So what happens in Argentina is important, but not quite as important as it is in what's happening in Brazil. So we're seeing a little bit of a bump today. Is that going to translate into a whole bunch of new export sales? I'm not really convinced yet. We'll have to wait to see. Obviously, we're going to be monitoring this very, very closely. So how are we doing with futures markets? I pulled these charts this morning. This is the chart for March corn. So if you're selling to the local ethanol plant or in an elevator today, they're going to use these futures prices. They're going to subtract out the basis. The blue lines that I drew in are support and resistance levels. Those are kind of key pricing points. You can see that we have recovered a little bit from our USDA announcement on January 12th. My best guess right now, unless there's something really major that changes or shifts this, I think we're going to be kind of a sideways trading pattern for a while. There really isn't a whole bunch of reasons where prices should go higher, but it'd be tough to make an argument that they should go lower. When we look historically, so this is the same chart, but we're going to go back looking long term. So this is the corn chart going back to 1990. Now it's not been adjusted for inflation. So the stuff over on the left-hand side, 1995, 1996, that's in 1995 and $96. The point I want to make is when we look at our inventories and what that means for prices, we're looking at kind of more normal or typical inventory levels, just similar to what we saw in 2015 through 2020 for inventories, okay, versus when we have very tight supplies, we have high prices, a lot of volatility. We're in this environment now where we're kind of back into this normal, mundane kind of corn market. And I know that's going to be very frustrating for people. What we really need is to have a big shock value to be able to get corn to rally. So I want to hit a reset button a bit on what are people's expectations, at what price level would you be willing to sell more corn? Just realize that we're in this environment now where the buyer's kind of in control, right? There's both domestically and globally large corn supplies, and so buyers can afford to be picky. Okay, when we look at soybeans, this is the nearby soybean chart. So this is March old crop soybeans. This is as of this morning at about between 8 and 8:30. I pulled these charts, tried to make them as current as possible. We've had a little bit of a pop this morning. Again, primarily because of the news coming out of Argentina that there's some dry weather conditions showing up. The extended forecast is for continued hot and dry, so it's something that we're going to have to watch very, very closely. Okay. Now, we see a little bit more volatility in soybeans, but just like I showed you before, we're kind of getting to the end of our major export season. So we got to be very cautious about soybeans to saying how much more of a rally can we get out of the soybean market, given all the information and conditions, the information in the current market conditions. When we look long term, to put this in historical perspective, again, this is the chart that goes back to 1990. We look at today's values versus history. We're kind of in this more normal pricing pattern. We're not really in that high upper range where we see high prices with a lot of volatility. We're going to be in much more of a kind of a sideways trading pattern, is my opinion, as we move forward. So with that, I'll stop sharing. Hopefully we allowed some time for questions, and I'm sure there's something that somebody wants to talk about. So Matt, I'll hand things back off to you.
Thanks, Frayne. Really appreciate it. Since you have the floor right now, Frayne, would you mind taking the first question?
Absolutely, please.
Okay, let's see here. I've got one directed to you specifically. It says, for Frayne, what is your opinion on soybean basis in the near term on old crop? Local elevator was as bad as $1.50 down at harvest. They've improved to 90 cents under for March. Normal for us is 60 to 70 cents under. Do you think there's a possibility of any more improvement, or is this as good as it will get? Thank you.
So I think it's going to be really tough for the basis levels to improve too much. We might see a little bit of an improvement. So our biggest challenge in the northern plains here is that a lot of our soybeans are shipped out of the PNW. Okay, and so the basis levels that you see in our local elevators are really reflective of that West Coast market. But you got to understand, about 60% of all the soybeans we export go through the Gulf of Mexico, even those shipped to China. So the Gulf of Mexico is still the primary market for shipping soybeans. And a lot of the reason that Iowa and Illinois and the Corn Belt has better basis levels than we do is because the shipping costs for barge freight, moving it down the Mississippi River, is so much cheaper than putting it on a train and going out to the West Coast and having to climb up and over the Rocky Mountains. So what we really need is to have a surge of exports or shipments of soybeans to meet the export market out of the PNW. Now, most of the soybeans out of the PNW, the vast majority of them go to China. So the PNW market is really that China market. And so in order for us, our basis levels locally, to really see a lift and improvement, we'd really need to see a surge of exports out of the PNW, primarily going to China. And is it possible for that to happen? There might be some conditions in the future that would lead to that, but I think the odds are pretty low. So I guess I would not bank on a marketing plan that really relied on a big improvement in basis.
Okay, very clear. Thank you. Nathan, I will give you a chance here to come back in. Right under that question, I see one, and this I'll open it up to, but specifically it says, please give possible justification for oats bridge payment over $80 an acre. Thank you. So that was an eye-catching amount there on that for the current coming payments. You could maybe even open this up too and say, how was it calculated, or if any justification was given just generally for each crop. So
Yeah, so the way the USDA determined this formula, right? They set these prices. Oats was a little bit alarming, or not really alarming, but a surprise at $80 an acre. And the way that the USDA did this, they used their nationwide net income numbers for like all inputs, take away, average yields, and taking into account average prices for all these different commodities. And the farmer bridge assistant payment was roughly 1/3 of the difference from the negative farm incomes. So farmers lost $100 on corn, right? So the bridge payment was $40, right? Roughly 1/3 of that. On oats, apparently farmers lost about $250 an acre, and 1/3 of that was $80. So the payments were roughly like 28 to 35% of the expected loss that the USDA calculated. And I want to say it was I think rice was the outlier, Where rice, a southern crop, we don't grow it anywhere like 500 miles around here, 1,000 miles around here. Rice was weirdly like 80% of their expected loss. It was either rice or cotton. One of the southern crops had a crazy high
Percentage.
expected payment over the calculated loss, but it was simply that 28 to 35% of their expected loss. The USDA had $11 billion to play with. This is how they split it up between the different crops. Take it or leave it. That's
I,
roughly how they got to it.
I think that's pretty clear. Anyone that's helping me on the crops team behind the scenes, if they want, I'll put a plug in. We do have the small grains tour coming next month. So Joachim Wiersma will be traveling around Minnesota and holding town hall like meetings. And I think he wants to talk a bit about oats. So that's the bridge there. Um, okay, so how about acre flow this year, right? So we've seen what's happened in the past years. Maybe back to you, Frayne, a little bit, and Nathan,
Sure.
you can hold him up as well. How about the? I see a pop-up box got my way there. So the question specifically, Frayne, was: is there any anticipation to seeing acres go from corn and beans back to wheat, cotton, oats, etc.? So kind of building on that. Hey, we've seen different levels of payments, different profitabilities in these crops. What does next year and going forward look like? Do we start to diversify more? Might be a succinct way to put it.
Okay, and great question. The short answer is probably not. So, so right now, just to throw some numbers out. So last year we had 98.8 million acres planted of corn. The current market kind of number that I see private forecast is coming up with is about 95. So we're going to go from 98.8 down to about 95. For soybeans, we're going to go from about 81 to about 85. That's kind of our long-term average is 95 and 85. For wheat, we're going to go from about 45 down to 44. Okay, so slight cutback in wheat. And I guess in talking to farmers here in North Dakota, and again, this is a regional thing, the guys I'm talking to is saying, well, I know corn doesn't look great, but wheat's even tougher. And so, I think we're going to see a shift away from spring wheat and into corn within North Dakota anyway. The soybean acres in this region, I think, will stay about the same. Now, our problem is for some of the diversified, right, some of the smaller market crops. Our challenge is if you start flipping, let's pick on canola for just a little bit. If you store dry edible beans, or you can't do sugar beets, even oats, right? If we start shifting too many acres of corn and soybeans out of those and into these smaller market crops, we suddenly flood the market. I mean, and when talking to some of the specialty crop marketing people, they're really concerned. Most of those are contract based. You sign a contract before you produce the crop. And most of those guys are saying, look, we want to hold the acres we have. We don't want necessarily have a bunch of new acres. Because if we end up with these new acres, I'll think about, like, for example, barley, malting barley. I mean, it's so easy to flood that malting barley market with just a small shift away from spring wheat and into barley. And then all of a sudden, the barley market has these huge surpluses for 2 and 3 years at a time. So it's going to be really, really challenging. And it's going to be a real fine line balancing act to try and figure out what do we do. There's no incentive to put more cotton in. The cotton guys are losing more money than anybody else. And Nathan's absolutely right. It's the cotton and rice folks are losing their rear end. They're not going to put in a bunch of new acres. The sorghum acres are going to be and soybean sorghum prices are really driven by corn because it's almost a one-for-one substitute. There just really isn't anything out there that looks like it's going to be the winner this year.
Okay. Well, I think the old adage is just kind of help us summarize and wrap here is that low prices in markets can kind of create demand, right, in the long term.
Correct.
And if we're looking at even crops coming in and strengthening the rotation, it could be even a longer cycle yet in terms of demand and local market creation. So I just appreciate both of your expertise. For anyone listening, I'm sure there's a lot more questions. There was a ton of engagement today. Of course, very stimulating topics brought to us. Our sponsors again are Minnesota Soybean Research and Promotion Council and the Minnesota Corn Research and Promotion Council. They make this possible. And so we thank them very much and all the checkoff money that supports it. And reminder, next week's session for strategic farming will be on pollinators. The guest is Dan Caraveau, Associate Professor from the University of Minnesota Bee Lab, and the host will be Claire LeCan from the Extension Crops team.